Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, when I first started out in financial markets as a newbie on a trading floor, one of the first data points I was introduced to was the US yield curve. Now, as many of you know, the yield curve refers to specifically the difference between long and short maturity bond yields. The two most common yield curves, of course, are the difference between the 10-year and 2-year yields and the 10-year and the 3-month yield. Between the both of them, they not only have a better track record of predicting recessions in the US compared to most other indicators, but as we learn a little bit more about today, they can also help narrow down the likely timing. Now, to discuss this and more about what this indicator is telling us and how we can respond as investors, I'm pleased that I'm to be joined by Raymond Cheng, our Chief Investment Officer for North Asia. So, welcome, Raymond. And look, let's jump right in on US macro. We've been getting quite a bit of deteriorating economic data in the US. And indeed, as you pointed out earlier, gold prices have been rising. In your view, has the US economic recession already begun?
Thanks, Manpreet. Let me approach your question from the perspectives of macroeconomic data, bond market signals, and corporate earnings. Now, starting with the US corporate earnings. The street estimates appear to suggest an earnings recession, as the ongoing Q1 earnings season marks the second consecutive quarter of year-on-year earnings contraction. Consensus estimates Q1 earnings growth at down 5.2% year-over-year. This follows a 3.2% year-over-year contraction in Q4 of 2022. Now then, at the macro level, almost all our US recession indicators, except for job market data, have been flagging warnings in recent months. Even the job market is starting to weaken, as seen in declining temporary employment, less number of working hours, falling job openings, and steadily rising unemployment claims. Now, while non-farm payroll gains of 236,000 in March beat expectations, the strength was narrowly supported by leisure and hospitality industries. The March unemployment rate did deliver a positive surprise at 3.5%, improving from 3.6% in February. As the bank lending conditions tighten, the job market will likely deteriorate from here. Now, the bond market signals also give us some insights. Tracking the past 4 US recessions show that the recession happened anytime between 2 to 16 months when the yield curve between the 10-year and 2-year US bonds was most inverted. This time around, as the US yield curve turned most inverted in March this year, this raises the prospects of a US recession by mid-year. Now, it's important for investors to know, as consensus is upbeat at the moment on US earnings growth returning to positive territory in the second half of the year. Now, this means capital markets have yet to price in a recession. Some argue that equities sometimes perform well once the Fed pauses, but history shows that only happens when there's no recession. As core CPI accelerated to 5.6% in March, the Fed will likely want to induce a mild recession to tame inflation. Given this, we will continue to use the rally in risk assets to move to a more defensive position, focusing on income-generating assets. We therefore recommend a rebalance to developed market government bonds and investment-grade rated Asia US dollar-denominated corporate bonds. The US 10-year Treasury yield has strong resistance at around 3.61%. Now, we view this as the attractive level to lock in longer maturity bond yields. Within equities, we would rebalance to Asia ex-Japan. Now, China, we're seeing credit growth in March picking up, which combined with cooling inflation provides more room for further stimulus, and hence our positive stance on China equities.
Thanks, Raymond. I think that's indeed some interesting signals coming from the macro data. But I want to talk about the US earnings expectations, because you mentioned that, of course, being one important sort of factor. And in the US, the Q1 23 earnings season is about to enter full swing. What are your expectations from this earnings season?
Sure. Well, elevated inflation and slowing growth have continued to challenge corporate America. Now, the street expects the S&P 500 Q1 2023 earnings to fall 5.2% from a year ago, according to Refinitiv estimates. That this compares with expectations of a 1.4% rise in January 2023. Now, this will mark the second straight quarter of earnings decline, while profit margins are expected to contract. Now, such downward pressure is broadly felt by almost all except 4 industry groups within S&P 500. Therefore, we maintain a defensive sectoral stance in the US, preferring consumer staples, healthcare, and utility sectors at the moment. These sectors' earnings tend to be more resilient during recession times.
Okay, no, thanks, Raymond. So looking for resilience in earnings there. But shifting gears to the bond market for a second, several commentators have argued that the outlook for the 10-year yield has weakened somewhat after it broke below some key moving averages. What's your view on the bond yields, and specifically, what do you believe it means for income investors?
Yeah. US Treasury bond yields have been making lower highs and lower lows, which happened at a time when the market refocused back on downside risk to economic growth. The US 10-year government bond yield fell to as low as 3.31% before retracing above 3.4% over the past couple of days. Now, meanwhile, the Fed remains rather hawkish and is likely to deliver another 25 basis point hike in May. From a technical standpoint, 3.52% is a key resistance level for the 10-year yield, followed by 3.64%. On the downside, we see near-term supports at around 3.386% and 3.259%. Now, interestingly, credit spreads, which is the yield premium over treasuries, have widened modestly across many income sub-asset classes, including bonds. This has helped offset some of the declines in government bond yields. For example, our preferred Asia US bonds are now offering an all-in yield of 6.29%, not far from a month ago. So we think the window to add to income assets remains open, despite the fact that US bond yields are trending lower.
Okay, so income window still open, but staying on that income theme for a second, we've got a lot of questions recently from many listeners about the Singapore REITs sector, which of course is a key component within any income allocation. Can you tell us a little bit more about your outlook on this area?
Sure. Well, the Singapore REIT sector has been underperforming the broader Singapore market for a while. The rising interest rates and bond yields have been a headwind for property valuations and financing costs, and this is particularly relevant to REITs that tend to be highly leveraged. Singapore REITs face multiple challenges as well from COVID-19, with lockdowns affecting retail, hospitality, and industrial assets, as well as work from home impacting office assets. Some of these negative forces do remain. But on the other hand, the e-commerce boom spurred demand for warehousing and logistics. The interest rates in Singapore typically track those of the US, where we expect another 25 basis point of rate hike before the Fed pauses. When that happens and bond yields subsequently fall, we believe the interest rate headwind will turn into a low rates tailwind for Singapore REITs. Now, the major Singapore REITs are relatively well managed from our point of view, with rental growth and cost control generally offsetting cost inflation and higher interest costs. The continued economic recovery should bolster hospitality and industrial assets, while structural growth is likely to support data center and logistics assets. Now, in Singapore, limited new supply of Grade A offices is also supportive of the market as it continues to digest work from home trends. Therefore, we expect bond yields to fall by end 2023, thereby improving the outlook for Singapore REIT as a whole.
All right. Thanks, Raymond, for your time. I think we've run out of time, so we'll bring it to a pause there. If I can again sum up, I think it was an interesting discussion today, but 3 takeaways from my end. One, of course, the economic data arguing that there indeed is a high chance we get a US recession relatively soon, which does, of course, illustrate why we favor developed market government bonds and high-quality Asian dollar bonds. Second, of course, on the Q1 US earnings season, in our view, offering grounds indeed to favor the more defensive sectors in the US. And third, of course, look, US Treasury yields may indeed have fallen, but the window to add to income strategies more broadly, in our view, remains open. So we'll bring the podcast to an end here. Thank you, Raymond, again for today's discussion. And thank you, listeners, of course, for taking the time to listen to us. We hope you enjoyed today's podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.